Hey everybody, Economic Ninja here. I hope you're doing great. I have got a story. I'm going to share just a little bit about it. I'm going to link it below, and I'm going to explain at the end of this how the Federal Reserve is about to make your personal life even worse. And that is, boy, it is going to make inflation in your life go up exponentially. Here we go. It's entitled "The Fed's Favorite Inflation Indicator Unexpectedly Surges as Personal Spending Jumps." Sorry, got a frog in my throat. All right, it says, moments ago, the BEA reported that in August, personal income and spending came in at 0.3% and 0.4% respectively, the former in line with expectations, and slightly higher than the 0.2% increase in July, while the latter spending printing well above the consensus forecast of 0.2% and far above July's negative 0.2% decline. Let's go back to that real quick. Boy, what is wrong with my voice? It was fine a second ago. Let's run with it. So in July, we saw inflation drop a little bit, and everybody's excited. And I think President Joe Biden was saying, see, inflation's dropping. And everybody's like, well, the inflation numbers from July came in the same as March, so we must be going down. And I gave you a video and I said, look at what happened the July before last, and the exact same drop happened, a seasonality, normal effect happened in July. And a lot of people understood, a lot of people didn't understand, and they thought inflation's heading down. Now we see that is not the case, all right? So I wanna start with that. Let me come back down and we say, there is still more than enough to keep inflation red hot, and indeed, the punchline from today's report that both the PCE and core PCE, the Fed's preferred inflation metric, came in well above expectations. And again, remember, I've said this before too, you're going to constantly see the professionals, the ones that are allowed to tell you what to do with your money, the ones that went to college and got all these fancy degrees. Problem is, they could tell you what to do with their money, or your money, and they tell you what's going to come in the future. Problem is, they're consistently wrong. And you want to know why? The reason why is because they were not investors before the housing crash. They were not investors before the dot-com bubble. And that is the consistent problem you see all over the mainstream media and even on YouTube. It is very rare to find somebody that was an investor prior to those that can actually see the sea changes in the economy and tell you what's going to happen next, because there's nothing new under the sun. Yet every single day we meet another quote-unquote professional that doesn't know. Boy, there's all kinds of thoughts in my head. Put down what I was going to say, what do you think I was going to say? I shouldn't say it on YouTube. But don't say that in the comment section. Make it clean. My point being is these guys do not know the writing on the wall. They don't understand the sea change because they have not been invested before, all right? So they're consistently wrong. Now, it says, to wit, on an annual basis, headline PCE printed 6.2% year over year, above the 6% expectation, or the expected number. It was below July's 6.4%, while core PCE came in at 4.9%, also above the 4.7% expected and unchanged from an upward revised July print. Couple things. So again, consistently wrong. It's higher than they expected, and the revisions. Remember, I tell you this all the time, that you have to watch the revisions. They'll come out with a number and the stock market will rally because it's either better than expected or it's at expectations. But then later on they go, yeah, we screwed up. Here's the real number. The thing is, it's not been in the media. It's not in the media at that point because nobody's expecting that revision number, right? It's everybody's waited with bated breath on Wall Street, like, what's the PCE going to come in? What's the PCE going to come in? Or what's the unemployment numbers going to come in at? And then when it comes out, everyone like either reacts downward or upward, right? Or just sort of, okay, it's expected. But you're not expecting, you're not anticipating, Wall Street at least, the revised numbers. And by then, they don't care what the revised numbers are. Why? Because they're out looking for the next expected number to come out on Wall Street. All right, so that's something very important. You have to watch these revisions. That tells you what's really happening to the economy. And right now, we're sinking. Now, I'm going to hold off. I'm going to link this story below, and then I'm going to explain something. The Federal Reserve right now, this is how it's going to affect you, and it's going to make this worse, and this collapse is going to get even heavier. As the Federal Reserve raises the benchmark rate, right, the Fed funds rate, it makes it more expensive to borrow money for everyone, all right? So that means your food company needs to raise rates eventually because it's going to get more expensive for them to borrow money. Every company that produces a product or service that goes to your home is about to have higher borrowing costs. And have you ever heard the term, if you're not trying, you're dying? Well, that's how all companies think about finance. Because if they're not trying to grow, they're not growing. Well, how do you grow in this world? A lot of times, and I teach this in my side hustle course, how you need to stop growing off of debt and you need to start small, a cash position, and build and build. Very few companies in this world think like that. And what they do is they borrow. They look more at, I can write off the interest and I can accelerate my growth because I'm using someone else's money to expand. And the problem is they get into this perpetual cycle with that, with borrowing money. And what happens is, as the Fed funds rate goes up, their cost of borrowing money goes up. Eventually, they try and hold it off because they want to keep their margins, clean and making lots of profit, but they also need to try and stay competitive with other people. And I've explained this before. As their costs go up, they try and stay competitive. They don't push that cost off to the consumer initially, but eventually they have to push that cost off to you. All right. And the problem with that is that everything's going to go up. So right now we have information about the PCE coming out, and personal cost, personal inflation have gone up again. Oh, no surprise to Ninja Nation. All right, you're not paying attention to the official numbers. You're watching, as I explained to you, what happens on the backside and what's coming in the future. And what is coming in the future are higher consumer prices because borrowing is getting higher and more expensive for companies that provide you goods and services. All right, so what do? How do you fix this right now? Well, when you have necessities in your life, like food, you go buy extra food right now. This isn't a joke, right? Not only do you have consumer prices that are going up, borrowing costs for companies that are going to increase, or like as fuel goes up to deliver those goods and services to your doorstep or to your grocery store, those are going up. You also have geopolitical risks and threats that literally hurt the global food supply chain. Go and buy food. Another thing is, look at things that you can pay for right now for the whole next year. It sounds funny. I'll give you an example. You could think of it, Netflix or anything, subscription services that you have that are on a monthly basis that you can pay for in a 1 year period that you know you're going to use for the next year. Use my father's example. He has an RV at a RV lot, and he's watched over the years them consistently. He stores it there, nice place. They consistently raise their prices. Why? Because the demand is high. So why wouldn't they do that? So what happens is, if you're on the month to month, you are subject to it being raised $25 almost every couple months, it seems like. So he goes out and he goes, hey, how long can I prepay for this thing? And they say, well, we only let it for 1 year. So he goes, I'll prepay for the whole year. And in that year that he prepaid, he watched them raise rates, I want to say 3 times. And it would have been him. And it was just one little simple way of saving a little bit extra money. So start thinking about things that you can go prepay for in advance right now that you know you're going to use for a year. Because right now what's happening is all the cash in your bank account, it's just losing money. All right, just think of it that way. You're literally losing money to inflation because the government and the Federal Reserve, which isn't government, they're not federal, they don't have any reserves, they are literally stealing from you through inflation. Guys, I'm going to link this story below. Go check it out. And thank you to all the new subscribers. Thank you to everybody that hit that subscribe button. You guys are incredible. With that being said, the Economic Ninja is out.